If the US dollar is still strong, then why are so many wealthy Americans quietly moving their money out of it? They're not screaming. They're not panicking. They're just shifting away from cash, away from the banks, and into something they believe will survive the next shock. Want to know what they're betting on? Let's break it down. 1. The dollar isn't what it used to be. The US dollar has long been seen as the king of currencies. It's the global reserve. It powers international trade. It backs the world's most powerful economy. But none of that makes it invincible. Over the past few years, inflation has surged. Prices have climbed faster than wages. Groceries, rent, gas, everything costs more. And while interest rates have risen, they haven't kept up with the real cost of living. Holding cash today doesn't preserve wealth. It slowly drains it. Even if your savings earn 4% in a high-yield account, inflation eats away at those gains. Then taxes take a slice. At the end of the year, your safe money may have actually lost value. Wealthy investors see this clearly. They're not fooled by nominal returns. They focus on purchasing power, what your money can actually buy. And when that purchasing power drops, it's time to move. They're not abandoning the dollar overnight, but they are rethinking its role. It's no longer the foundation. It's a piece of the puzzle, and a shrinking one at that. 2. Quiet wealth is moving out. Here's what's really interesting. The smart money isn't making noise. It's not running ads or ringing alarm bells. It's moving silently and strategically. Ultra-wealthy families, hedge funds, and institutional players are reducing their exposure to US dollars. Instead, they're reallocating into assets that hold value across borders and political systems. Gold is back on their radar, not because it's shiny, but because it's reliable. Real estate in stable countries is attracting attention. Farmland, water rights, infrastructure, anything tangible and income-producing is in demand. And yes, even crypto has found a place in some of their portfolios, not as a primary asset, but as a hedge against the centralized risk. The common thread? They're seeking optionality, the ability to pivot when the system falters. When you diversify outside the dollar, you're not betting against America. You're protecting yourself from uncertainty. Think of it this way. The dollar is like a boat. It's carried us far. But if the waters ahead look rough, the rich are quietly packing lifeboats, just in case. 3. Central banks are sending a message. Want to know what the smartest institutions in the world are doing? Watch the central banks. In the past 2 years, global central banks have bought more gold than at any point in modern history. Countries like China, India, Turkey, and Russia are leading the charge. But they're not alone. Even allies of the US are quietly diversifying their reserves. They're not dumping dollars, but they are reducing dependence. Some nations are settling trade in non-dollar currencies. Others are establishing gold-backed agreements. It's not just symbolic, it's structural. These are moves made by those who understand monetary systems deeply. If the very institutions that issue and manage currency are hedging with gold, what does that tell you? They know that financial systems are cyclical. They've seen empires rise and fall. The dollar has been dominant for a century, but history says nothing lasts forever. When central banks diversify, it's not emotion, it's preparation. 4. What they're buying instead. So where is the smart money going? First, into hard assets. Gold, of course, remains a cornerstone. It's not about price speculation. It's about trust. Gold doesn't default. It doesn't rely on politics. It simply holds value. Next, real estate, especially overseas. Properties in Switzerland, Singapore, Australia, and even parts of Latin America are attracting interest. These aren't vacation homes. They're strategic stores of wealth. Commodities are another target. Energy, agriculture, rare earth minerals. In a world of rising demand and disrupted supply chains, tangible resources matter. There's also a growing interest in alternative currencies. Not just crypto, but foreign fiat as well. Some investors are holding Swiss francs, Singapore dollars, or even Norwegian krone, betting on fiscal responsibility over size. The key idea isn't to chase the next big thing. It's to build resilience, to own things that governments can't print, freeze, or inflate away. Wealthy Americans are building portfolios that can survive shocks, not just grow in booms. 5. What you can do. This isn't just for billionaires. You don't need a private jet or a Cayman account to think smart. Start by allocating a small percentage of your savings into hard assets. Gold ETFs are accessible. Physical bullion is simple to store. Even tokenized assets on the blockchain offer new ways to diversify. If you own property, think globally. Could you one day own a small plot overseas? Could you invest in farmland or REITs with exposure to energy and agriculture? Most importantly, Shift your mindset. Don't assume the dollar will always be strong. Prepare for the possibility that it won't. Diversification isn't fear, it's discipline. And remember, the rich didn't wait for CNN to tell them what to do. They watched the signs, made quiet moves, and stayed ahead. You can do the same. Closing thought. The US dollar might look stable, but the wealthiest people in America aren't betting on appearances. They're betting on patterns, and those patterns are shifting. Gold, land, energy, and foreign assets aren't just trendy. They're timeless. If you've ever wondered how the rich stay rich through every storm, this is it.